Good evening, ladies and gentlemen. We're Team 4A. By the time you're seeing this, we're saying hi from Argentina. My name's Jenny. Here are my team members.
My name is Jamie.
I'm Gavin.
I'm Terry.
And Gavin will start our presentation.
Okay, let's go over our investment objective first. Our goal is mitigate the risk over investment horizon. Our targeted return rate is 9%, which is 1% higher than the 10-year S&P 500 average. We want to keep our standard deviation of portfolio under 15%. And we need to meet all the investors' objectives and the risk constraints. We are looking at the following economic outlook while we are making our investments. The Fed is still keep the interest rate low, but likely to increase that in the near future. There will be no more QE, and the U.S. currency is gaining strength. The U.S. GDP growth is 2.2% in 2015. The inflation rate is picking up, but still at a very low level. The unemployment rate is steadily dropping. Right now it's about 5.3%. China has a GDP of 7%. They reached that goal in Q2 of 15. And we are certainly facing some financial uncertainty due to the recent global events in Greece and China. Our investment strategy will be using enhanced indexing, like over the 10-year time horizon. We will emphasize on value equity based on a stratified mix across industry sectors. Our assets will include ETFs, mutual funds, derivatives, equities, and bonds. We use technical and fundamental analysis and benchmarking. We also emphasize on building a well-diversified portfolios. This is our asset allocation. We'll have 70% allocated to equities, about 10% to international equities. We'll have 20% in bonds and 10% in cash. Our method will be diversified portfolio using ETF, mutual funds, and bonds. Our stock selection will be based on various metrics, and we focus on growth stock and blue chip stocks. Our diversification between different sectors will include healthcare, technology, and international. In terms of option strategy, will be based on the covered positions and the income production.
I'm going to talk about our investment policy statement. Our portfolio target, as Gavin mentioned, is 1% higher than 10-year S&P 500 average return. And fund is targeted at investors in both low and high cap area with a focus in sectors that historically outperform index, such as technology, healthcare, consumer durables. Our time horizon is 10 years, and we have initial investment of $1 million, and funds will be part of our total retirement portfolio. We meet every week to review our performance portfolio and to see based on our macroecon and industry trends knowledge. We will willing to lose 20% of our fund, and we have conservative view of current market conditions, and we will reduce our risk by diversifying portfolio using ETFs and mutual funds. We will manage riskier stocks by using option plays, and we will keep the standard deviation less than 15%. And we will maximize the return on investment frontier based on the risk objectives. We will maintain 10% cash in our account as our emergency fund. And since we have $1 million, we will assume 35% tax will be our tax bracket. And we will follow long-term investment approach, also avoid short-term capital gains. The benchmark we will use S&P 500 10 years average return, which is 8%. Here is a general sector performance, S&P 500 has experienced an 83.90% increase in 5 years, and healthcare and telecom, they're all performed pretty good during past 5 years. Let's talk about the capital market expectation. We stay positive on U.S. equity, international emerging market, U.S. Treasury bond, U.S. corporate investment grade, U.S. real estate, and commodities. Next slide, we're going to talk about, here is our economic conclusions. We think business and housing market will have the positive impact on bond, and consumer market will have the positive impact on the equity market.
And then I'll be going over our investment security selections. First, I'm going over the stock. First one is Apple. It's in the consumer goods sector. We picked it because it's one of a blue chip stock, and it has consistently outperformed the S&P. It has low price to earning ratio compared to industry average. Second one is PayPal. Even though it has not much of a history in the background, it's new, and but it's belonged to the service sector. We see it as a growth stock. PayPal's revenue actually exceeds eBay's market price revenue. The next one would be United Health Group. It's belong to the healthcare sector. It's one of the defensive stock. The company has strengthened the revenue growth, solid stock prices performance, impressive record of earning per share. It is one of the stock is making us positive outcome for our final portfolio so far. And the next slide will be going over the ETF and mutual funds. We picked the Fidelity Blue Chip Value, FBCVX. It's in the various sectors. The fund invested at least 80% of assets in blue chip companies. The fund has returned 8.73% over the past year, 19.13% over the past 3 years. Next one is the Gold Trust. The gold has on this unstable stock market, we see gold as safe haven. It's an attractive long-term investment. The next one is the S&P 500 ETF. It's in the various stock sector. SPY is an handpicked group that's weighted by the market capitalization. One of the advantages is its liquidity, and it tends to outperform the smart money. The next slide will be the funds. Vanguard Total Bond Market Index Fund, the VBMFX. It's exposure to international market, and it's mortgage-backed security as well. Next one's the Vanguard Total International Stock Index Fund. It's one of the international stock fund, and VGTX. It has a broad exposure to the international equities, including both emerging and developed market, as well as some of the small cap stocks. Last but not least, the Vanguard Total Stock Market Index Fund. It's in the various in various sectors. It provides investors with exposure to the entire U.S. equity market, including small, mid, large cap growth and value stocks. And so far, the two international funds are making us a positive outcome for our final portfolio. The next slide is our bonds. We picked a 15-year U.S. Treasury bond. It's a risk-free. And Microsoft bond, we see it as AAA rated. The company has significant financial strength, it has a strong recurring revenue and high customer retention rate. And I also want to mention for our derivative strategy, we go for the straddle and the cover short call. We actually purchased both put and call option with the exercise price of $35 on PayPal, and sold call option with $105 strike price at Apple. And Tate will go elaborate further on that. And next slide over would be our overall security selections based on 70-30 on the equity. So overall, those are the selections, and we'll end up with 73% in equity, and those are the beta that associate with our stock selections.
And as Jenny mentioned, our option strategy, we did have a couple options. The first one, we decided to try to gain some income, so we actually sold a call on Apple because we all felt that the Apple stock was going to go down further, and it was over a 1 week period. Unfortunately, Apple stock did go up, and we did lose some money on it, but it was a great learning experience for us. The other strategy, we did a covered call, a straddle with the PayPal stock. The reason why is because PayPal is fairly new, and we're expecting the stock to be pretty volatile, whether it goes up or down. And using the straddle, it protects us from both ends. And as you can see in this slide, this is our asset allocation. And as you can see, we did a pretty good job of distributing the different types of classes. The highest percentage was at 17% with United Healthcare, because that is a defensive stock, reducing the overall risk. And as you can see with our total diversification, we did stick to pretty close to our strategy, where we went 73% in equities, 9% in cash, and 18% in bonds. And this slide shows that we further did allocate with about 10% international and 90% domestic. This next slide shows the correlation matrix. What it shows is that we actually did a pretty good job of diversifying the beta of the portfolio. So as you can see in green, those are all where the correlation is actually negative, which helps as actually reducing the beta and the risk. The numbers in pink are the betas that are closer to 1. So as you can see, there are a lot more greens than there are pink colors there. This next slide shows the performance evaluation of each of our individual stocks and mutual funds. And as you can see, our overall holding period return on this was, we lost 0.5%. And it's actually a little bit lower than what StockTrack's calculated, because we did not include the straddle options, as the time period has not expired as of yet. This next slide shows our performance evaluation against our benchmark, which is the S&P 500. And as you can see in the beginning, we didn't start executing our strategy, so we're actually below the S&P, but once we started implementing and buying the different types of stocks and bonds and mutual funds and ETFs that was part of our strategy, we actually did beat the S&P as of today by close to 4%. And as far as our analysis, we did a weighted beta of the portfolio, came out to 0.592, which is pretty low, and that shows how well we diversified our portfolio and reduced our risk. The standard deviation of the portfolio was at 1.04%, and we all felt that was pretty low, and we felt that it might be skewed because of the short time horizon. So with over a 10-year period, we're estimating probably closer to 10%. And our Sharpe ratio that we got from StockTrack showed us at negative 1.12. And our expected return, we did base it on the 10-year Treasury bond as far as the risk-free rate, because our 10-year was the time horizon, and that was at 2.12%. And mixed in with our beta, using the CAPM model, our expected annual return came out to 5.6%, which is a lot less than what our expected return was when we started the investment strategy. And finally, the conclusions and the lessons that we learned from this. First thing we learned is that with a strong diversification strategy that we had, it actually helped us when with a downturn in the market, as we showed a smaller loss than the S&P 500 overall. The second thing we learned is that the gold is actually a great tool as far as diversification, because we found that it had negative correlation with a lot of the stocks and mutual funds and ETFs that we had in our portfolio. Third, we also learned about selling the options. As we mentioned about Apple, we did gain some income initially, but we lost in the long run. So we learned that we need to do our due diligence and really look into it before we decide to sell a call or a put. Fourth, we decided to increase international funds during times of volatility in the domestic market. That will help decrease our overall risk. And fourth, we know that using derivatives, we can actually profit or benefit from both a bull or a bear market, but we do have to use the derivatives in an efficient manner, and that will help us. But the biggest thing that we learned, and our final conclusion, is that with a long-term horizon, possibly having a low beta and a very risk-diverse portfolio may not be a good thing, because it does reduce with expected returns is with the expected risk. So with low risk, the expected return is lower. And with a long time horizon, we want to be a little bit more aggressive, possibly even reducing the amount that we hold on cash and going maybe into small cap stocks. But definitely a more aggressive strategy with a higher beta would serve us better in the long run. And on behalf of my team, we want to thank you for your time. Any questions? Well, thank you.
Thank you.
Bye.
Have a good night.